Suvodeep, Rakshit also joining us this morning on that topic. Suvodeep, thanks for joining us. You've revised the FY21 GDP growth to -2 and expecting growth to slip to -7.2% if COVID spreads further. Under what scenario do you see growth slipping down to that extent, to 7.2, and what's leading to such drastic downgrades?
Yeah, I think when we say -2 to -7.2%, I think that kind of indicates the kind of uncertainty in forecasting and estimating these kind of numbers, and it's kind of trivial in some sense, and the whole exercise in giving out a point estimate. So a range is always better. Now, when we are talking about a -2%, and as that's the base case that we are working with right now for a FY21 GDP estimate, that in effect is taking into account a 45-day lockdown. And when I say 45-day, it basically means 45 days in FY21. So till now, we are not taking into account any further lockdowns or any kind of disruptions, resurgence of infections, etc. coming in. So from that perspective, that forms the base case. Now, -7.2% kind of takes into account a slightly more a worst case kind of a scenario where there's a 45-day lockdown followed by few days, maybe a month of reopening of the economy, and then another lockdown of 15-20 days followed by that, and then again the whole cycle starts, that again resumption of the economy, etc. So that leads to a worst case scenario. Now the scenarios are massive. I mean the number of scenarios that you can build around this is huge. The point what we are trying to make is that couple of things. One is that consumption and investment essentially were in a slowdown mode even before we went into the COVID phase. In fact, if you look at the investment growth, it has been in the negative for 2 quarters, which is second and third quarter of FY20. So the economy was already in a slowdown mode. The COVID spread started, and effectively what led to, what happened due to the COVID spread was that there was a production shutdown that happened, and also a demand shutdown that happened. Now, with what's happening over the last few days is the government is trying to open up the economy, which takes care of the production shutdown. But the demand shutdown is something that may be more prolonged if we take into account potential job losses that have been happening, potential income losses that have been happening, and the kind of dislocation we have seen in certain sections of the certain sectors in the economy, especially which are at high risk. Now, if you look at the private consumption, that will be slower, given that large ticket items are will probably be low in the pecking order of consumers. The low ticket items possibly will recover faster. Now, and along with that, if you are combining something like the investment cycle, where the real estate demand will possibly be low, government capex plans will be on the back foot given the amount of spending it needs to do on on kind of stimulating the economy through income measures, through kind of credit guarantee schemes, etc. And the private sector also will have low appetite for investment growth. So from a GDP perspective or a growth perspective, the two largest drivers of growth, which is the consumption and the investment, both will be slow, which leads to our call that that for the first half definitely we are seeing negative growth in both the quarters, and possibly in the second half you're going to see marginally positive to say 2-3% of growth by the end of the FY21, which leads to an overall growth of around -2% that we are talking about in a base case scenario.
All right. Now, expectations from government stimulus as well, given that the government has limited fiscal room now, what do you think they can do? There are all kinds of figures going around in terms of, the amount of or the percentage of GDP that is desirable to really get the economy back on track. What do you think is a realistic expectation?
See, realistically, we have to kind of differentiate between a relief measure or a support measure and a stimulus measure. while the lockdown is on and while most part of the country, or at least the activity hubs in the country, are in a lockdown mode, stimulus measure does not have a similar impact as it would have in a normal circumstance. So for now, it is a support of livelihoods that is required, support of businesses that is required, while a stimulus, which basically acts through the demand side, or in terms of a multiplier effect, will come in after there is some normalization in economic activity. So to make that distinction, I think for now what you require is support of the MSME sector, support of high risk sector, for example, the high contact sectors, for example, the hotel, restaurants, travel, tourism. These are some of the sectors which would require some amount of help and support, which is where the government should be coming in with something like, say, a credit guarantee, which kind of takes away the credit risk to a certain extent, reduces the credit risk, and hence banks and financial institutions can lend to these sectors, which is required as of now. And when we talk about stimulus measures, it could be in the form of tax rate cuts. It could be in the form of transfer of cash to a certain section of the population. Those options will obviously be there. But overall, I think it's important to make that distinction that for now, while the economy is still in that partly or fully lockdown mode, we have to talk about relief measures and support measures. Once there is some semblance of normal activity coming into the picture, you talk about the stimulus measures. Also, we have to recognize that this is not, India does not have the capacity that something like the US or some of the developed markets have to have a massive amount of fiscal stimulus. So to that extent, it has to be a calibrated, it has to be well targeted, and it has to it has to come in doses when and as and when it's required, because it cannot be upfront, just take a number, a 10% of GDP that is given and everything falls in place, because it's a heterogeneous kind of model that we have in terms of the economy, and accordingly the packages should be looked at. So it should be quick decision as well as calibrated and targeted.
Sure. Suvodeep, I'd just like to come in and talk a little bit about your outlook then on the bond yields, because, with the government program, government raising the borrowing target by more than 50%, this, of course, is going to stand to impact the bond yields. And how, in turn, do you see that sentiment weighing on corporate borrowers raising bonds?
See, the first hit obviously comes through the GSEC market, and as a benchmark, then pricing of the corporate bonds, etc., will play out. I think there are a couple of points to note here that even without a higher borrowing, there was a fair amount of concern in terms of how to absorb that amount, the kind of issuances that we have been seeing, not just from the government but also from the corporates, the quasi-government agencies, the state government. So there was a fair bit of concern. What this, the recent increase in the government borrowing does is effectively kind of increase the demand for RBI support, so that the RBI needs to come in and support the markets. There is excess supply of securities that will be there in the market, and to ensure that the debt markets function smoothly, I think there is a necessity that the RBI steps in either with the OMO purchase, probably with a calendar, or probably do target unconventional but targeted buying of corporate bonds if and when, as and when required. It also kind of indicates that at the end game, which is basically if the OMOs also don't work out, there is always the partial deficit monetization that the RBI should be looking at. My sense is that once you have the GSEC market going smoothly, I think the corporate bond markets, etc., also fall in place. Obviously, the corporate bond market will have the credit risk attached to it, which needs to be taken care of through other mechanisms, not necessarily just plain vanilla OMO purchases, but maybe targeted purchase by the RBI, or some kind of credit guarantee, etc., that the government can give. So all in all, it's a government plus an RBI kind of a measure that is required to support the borrowing for this year.
Thanks very much, Suvodeep, for sharing with us the outlook on the macro front.